You've been told to invest early, stay the course, and let compounding do its thing. But what if I told you there are investment landmines no one talks about, hidden costs, timing traps, and psychological warfare designed to make you the loser? Let's break down the investing secrets they don't want you to know. You've heard the phrase, time in the market beats timing the market. While that's mostly true, here's the part they leave out. Staying invested through volatile periods is emotionally exhausting. According to a 2023 study by Morningstar, 40% of investors pulled money out of the market during downturns, even though they knew it might hurt their returns. Why? Because watching your portfolio drop by 20% feels like a personal failure, and no one warns you just how much mental discipline you'll need to ride it out. So, yes, invest for the long term, but prepare for the psychological cost of seeing red for months at a time. Technology has fundamentally changed how we invest today. Index funds are cheap, robo-advisors are efficient, but here's the trap. Total investing costs are often buried in layers of fine print. According to the SEC, even a 1% annual fee can reduce your retirement savings by 28% over 35 years. And it's not just the management fees. Look out for expense ratios, transaction costs, bid-ask spreads, and tax drag. Most platforms don't show these clearly. That 8% return you're dreaming of, it might quietly become 6%, just enough to miss your goals. Next up is one that we have all heard before. You've diversified across tech, real estate, and international stocks. You think you're safe. But during crises, correlations spike. Assets that normally move independently start tanking together. A Vanguard analysis found that during the 2008 crash and the COVID panic in 2020, even diversified portfolios experienced drawdowns of over 30%. Diversification doesn't eliminate risk, it delays and disguises it. True protection? That comes from understanding what kind of risk you're exposed to, and that takes more than just picking different ETFs. Now you have made your money. But we have all heard the saying, the only things inevitable in life is death and taxes. Now comes the time for taxes. Most beginner investors don't realize how capital gains taxes can eat into returns. Even reinvested dividends in investment accounts can trigger tax liabilities. According to Fidelity, unexpected capital gains distributions can be a major surprise for buy and hold investors. You thought you were compounding. Turns out you're compounding a tax bill. This one catches people out every day. Behind every investing truth is often a marketing team. From commission-free apps nudging you to trade more, to influencers flaunting option trades they barely understand. The system rewards activity, not outcomes. Why? Because your trading creates fees, engagement, and content, even if you lose money. Legendary investor Jack Bogle, founder of Vanguard, once said, "The more the brokers make, the less you make." So before you jump on the latest trend, ask, who really benefits from this advice? Investing isn't just about beating the market. It's about avoiding the traps built into it. Investing isn't the only area of our financial journey that have daily traps. There are plenty of traps that are disguised as help. Check out this video to make sure you don't fall into these traps and fall further away from your goals.